Good afternoon, everybody. Here we are. It's Monday, 17th of September. It's Paul here with what I think is our 8th session in the Admiral Markets webinar series of Mastering the 4 M's of Trading. As always, before we kick into the main part of our presentation, we'll just start with a quick risk disclaimer. Forex and CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. 83% of retail investor accounts lose money when trading CFDs with Admiral Markets UK. You should consider whether you understand how CFDs work and whether you can afford to take the high risk of losing your money. Please ensure you fully understand all risks involved. Forex and CFD trading is a risky activity, and this presentation and accompanying video should not be taken as advice for investing, as they only represent the personal opinion of the authors. The presentation and accompanying video is for information and educational purposes only. As of August 2018, the regulation within the European Union differs for retail and professional clients. In our presentation, we will use demo trading accounts where all clients could still use a high leverage in a risk-free environment. Before opening a live trading account, please consider the differences between retail and professional trading terms. Retail clients benefit from unlimited negative balance protection. Professional clients at Admiral Markets UK Limited receive a compensation of account deficits with a maximum payout of £50,000 as per our negative balance protection policy. Why would you trade with Admiral Markets UK? Well, they offer a wide spread of instruments and products for you to engage with markets. Their best offering is a DAX 30, which has a typical spread of 0.8 points. Euro dollar also has a typical spread of about 0.8 points during the main trading hours. It also provides the ubiquitous MetaTrader 4 and 5 platforms, and also the especially to Admiral, the Supreme Edition, which makes a massive difference to using the MetaTrader platforms. As always, if you have any questions about the presentation or about Admiral Markets, then feel free to get in touch with your account representative, and they'll be very happy to help and guide you. So let's talk about trading. Okay, so for those of you who are joining us for the first time, okay, for those who don't know me, my name's Paul Wallace. I've been trading for a long time now. Okay, primarily, I describe myself as a discretionary-based method trade, and ideally, I'm looking to trade swings on the dominant trend. I know that simplicity is key, and that's one of the things that will a recurring theme throughout our sessions here. And what I do is I tend to blend fundamentals, technical sentiment, geopolitics to give myself a decision framework. We're using technical setups as a trigger. Primarily, most of my trading is on FX, indices, and commodities. I will trade equities and crypto, but most of my focus is on FX, indices, and commodities. And within those, in particular in FX, my philosophy is I want to be buying strength and selling weaknesses within currency markets. Ideally, I like to use pullbacks for entries as a technical trigger. Looking at kind of weekly, daily, and 4-hourly charts, and then using, as I said, simple price action for entry. For my intraday trading, I'm the opposite. I'm primarily a mean reversion trader, so I'm looking for markets to overextend, and then I'll be looking to see if there's an opportunity to trade back into the average. So that gives you a little bit of idea of my own trading approach. And what we're going to do as part of all of these 4 M's of trading webinar series is we're going to touch more and more on that every week. The idea is it's just a little bit like the onion being unpeeled. It's just layer after layer just being removed for you to be able to learn and grow and evolve and adapt. As always, I try and set expectations for our sessions. The expectation on me is to educate you about the 4 M's of trading so that you can go away and analyze any market and be ready to trade it. And also, I want you to be able to have heightened self-awareness about managing risk and about managing yourself. For yourself, ladies and gentlemen, okay, I appreciate we have a broad range of experience in the room, and that I have 45 minutes. So sometimes that means I can be a little bit limited on the breadth and depth of topics. So I would ask you to bear with me on that. and what I'm always going to do is try and focus on the tools that you can use tomorrow. Okay, we can talk about trading for the rest of the year. Okay, quite happily, day after day after day. But the ultimate truth is that I want to be able to share ideas and concepts with you that you can take away and use tomorrow in your own trading. That's the main driver for our sessions. So for those of you who are joining us for our first time, okay, mastering the 4 M's of trading is all about, my understanding from, years and years of trading for myself, and also for working with traders, okay, in terms of mentoring and coaching traders from, sort of brand new retail traders up to, sort of professional traders at tier 1 institutions. Is that what we realize is that, the traders who do well, they are in control. They're able to master the 4 M's of trading: markets, method, money, and myself. If you go back to the first video in the session, which will be on the Admiral Markets Facebook and YouTube channel, you'll be able to watch it. I go into sort of some depth about the 4 different M's, okay? And as we're here for the first couple of months of the sessions, we're going to be focusing more on markets and method, which if you've joined us for the previous sessions, you'll realize. But also what we will do is we're building in elements on money management and myself as we become become more evolved in our understanding of the 4 M's of trading. And the reason is that, as I said, I've worked with some fantastic traders over the years, and what we learn is that, the traders, there is a sweet spot there, and the traders who are in good control of those 4 M's of trading tend to be the ones that sort of are able to consistently deliver, and actually that's where we want to be as traders, isn't it? That's where that's what we're looking to achieve. Okay, so hopefully, as during these sessions, as I help educate and enlighten you, that will provide us with some great pieces to sort of grow and develop as traders to help you in your own trading journey. Yep, and these sessions are all about weaving those 4 M's together. Okay, so there will always be a little bit of slides every week. I'll do a few slides just to remind us of our main sort of drivers, our main main educational pieces. There'll be a few slides on what new exciting things we can learn, and then with a bit of time we'll have a little look at the charts itself. And as I said, as you become more educated and you're able to sort of enjoy and learn from the sessions, we'll focus more and more on the actual the charts and the markets themselves, and start to sort of build and develop and employ all of the elements that we're talking about during the educational parts of the sessions. So if you remember, we talked about back over the sessions, is that what tends to help traders is for them to have a routine. Okay, it helps them to have a routine, to be able to follow a process. What that does is it helps sort of alleviate the opportunity for emotional trading or revenge trading, okay, or for taking impulsive trades. All right, remember that's that mastering that 4th M of managing myself. So having just a really simple little routine that you can follow whenever you open up a chart on on any instrument, whether it's 5-minute euro dollar or monthly gold, or the sort of 4-hour on Bitcoin. Okay, talk about having just some very, very simple routine that you can follow, and you follow it until it becomes an almost automatic prospect as part of your trading. All right, and we talked about this. Step 1, define your levels of support and resistance. Step 2, define if there is a trend. Step 3, wait for price to react at key support and resistance levels. Step 4, look for price action signals at support and resistance levels. And then step 5, which once we finish step 4, will be what is it part of a bigger chart pattern within the market itself. So remember what we talked about. Step 1, whenever you open a chart, step 1, define your levels of support and resistance. Look at the monthly, the weekly, and the daily charts. Draw in those horizontal levels of support and resistance. We can also use psychological round numbers. Okay, so you'll see, pound against dollar at the moment, like we're looking at 130. Dollar yen has been treble 1, although it's moved away from it a little bit there. Okay, dollar index has been around about 95, but being able to identify those psychological round numbers is also helpful. And we talked about in one of, I think maybe session 2, about you can use fractals, which is one of the indicators on the chart package to help you as well. Step two, if you remember, we talked about defining the trend, okay? Key element, okay, that's what I like to see from a trader, is can they actually identify whether that instrument is trending or consolidating? Now, we're going to focus, as you know, for new traders, we're going to focus more on, to begin with, on being able to sort of trade trends. And the unfortunate thing is that markets don't trend as much as we would like them to. Okay, generally, you're really looking at somewhere between about 15 to 30% of the time that market is trending. So, it's important for us to be able to identify when that market is trending and when that market's consolidating. As we go later down the sort of through the series, I'll do some pieces on trading range bound and consolidating markets. But to begin with, we're going to be looking at focusing, on when a market is trending. So, I put this chart up. This is DAX 30 on the weekly, and hopefully, you can see it very clearly when that market was consolidating, and also very clearly when that market was in a very nice uptrend. And that's what it is. I say this every week, okay, especially for the new traders. You don't need to force it. Okay, don't need to force it. If you're looking at a chart, and it doesn't matter what it is, if you can't really work out whether that's whether that market is trending, then I'll give you some advice. It probably isn't. Okay, good trends leap off the page at you. All right, they're there. And so if you're struggling, or if you're feeling as if you're having to force it, maybe take a moment to yourself, because the reality is it probably isn't trending. We also talked about using some simple moving averages, and you'll see on my charts the blue 20 period moving average, the red 50 period moving average, and the green 200 period moving average. And effectively, we use those to help identify, the sort of, that can help us with the identifying the trend, also the speed of the trend, when a trend is looking to sort of get towards its end, and also those moving averages you will find, we talked about, they become quite interesting levels of dynamic support and resistance also. So, what we talked about is, identifying your levels, identifying whether there's a trend, and then also starting to see, having a bit of patience to identify, those areas, where price will move to, those particular areas of, sort of support and resistance, okay, or big round numbers, and looking for a confluence of events, right? Looking for a confluence of events, looking for somewhere between, 2 to 4 things to be happening at one particular time and place on the chart, and being able to do that, okay, to wait and see how the price reacts at those particular levels. Our overall philosophy as well, okay, as I said, to begin with, we're going to we're just going to be starting with you just being a sort of a little bit of a swing trend trader, and and I say this every week. It sounds simplistic, but it's it actually never does any harm to be quickly reminded of it. When markets are bullish, you want to be a buyer. When markets are bearish, you want to be a seller. Define the trend and trade with it. No trend, no trade, no signal, no trade. Okay, I know that people who've joined us every week might say, well, Paul, you do this, these first sort of 4 slides the same every week, but it's true. It's because what I want it to do is I want it to become like almost automatic response for you. It's almost, as soon as you open a chart, that's exactly what you do. Okay, it becomes an almost mechanical, automatic response that that helps build good trading habits, and that's one of the things that I want to you to be able to take away from these particular periods and sessions. So, there we go. So, what we started over the last week or two is to sort of looking at step 4, okay, looking at the price action signals at support and resistance levels, okay, moving more and more towards the kind of that second M, namely the sort of, looking at the method. And last week we started to do a little bit on that, and we're going to build on that this week. So if you remember, a few weeks back, we very quickly talked about understanding methods, right? And I talked about how there are thousands of trading and investing methods out there. But generally, it just boils down to 1 or 2 styles. You're trading either a break of a line of support resistance or a bounce off a line of support or resistance, okay? It's either a break or a bounce. It's as simple as that. They both have their pros and cons, okay? Some people love trading breakouts, some people love to trade bounces. Personally, I prefer bounces, okay? I can and will trade occasionally breakouts, but as a general rule, I personally prefer to trade bounces, right? And I know, because I know it gives me an opportunity to enter at a better price. And also, if my trade isn't going to work out, I find out much quicker, which might sound a bit strange to new traders, okay? But I work on the premise that if my trade isn't going to work out, I'd sooner know as fast as possible that the trade isn't going to work out, because what you'll learn, traders, is that not only do you have financial capital on the at play, but you also have your emotional capital as well, okay? And and a trade that is just sort of trickling along, going nowhere, sort of eats away at you a bit. So if ideally I want my trades to work out, but the reality is they don't, okay? All of them do. So if I am going to be wrong, I want to know I'm wrong as soon as possible, so then I can get back on with back on to sort of looking for the next opportunity. And that's what I find pullbacks give me that opportunity. So if you remember last week, we talked about starting to look at some price action signals at particular areas and levels, and if you remember, we talked about a pin bar, or some people call it a rejection candle, some people call it we'll call it a shooting star, some people call it a high test or a low test. It's a very frequent pattern, okay, in the market, and it does give us a good indication of supply and demand, and it's very clear and easy to see on the charts, and many people will trade them, but not always like it. I will, and what I said last week is that we would just do the very sort of basic intro to trading, sort of pin bars, and then what we will do is we will come back to it as we as we go through and as we develop, and I will give you more advanced ways of actually trading them as well. So for those of you who joined, we did a lot more in depth last week, okay? So by all means, go and check it in the archive section. But realistically, a pin bar, it must have the open and close of the bar within the body of the previous bar. The candle wick should be 2 to 3 times the length of the body, and it should have a long nose protruding from all the other bars. There is an exception, but for the start of our investigation of pin bars, then we want to have like a long nose protruding from all the bars, and the really good pin bars, they will stick out. Okay, they'll be very obvious. As we had a little look at a few of them last week, and I'm sure we'll see them when we look at the charts this week as well. So if you might remember, we talked about what I described pin bars as the likely indicators of where biggest predators are lurking in the market. Okay, and I want to know that. I don't want to fight that, because actually what it's doing is it's showing rejection of a particular area or direction of the market. And I was saying that as a private trader, it's kind of pointless for you to try and fight them. Don't bother. What you want to do is use them. Okay, use them to help identify how you're going to work with them in the likely short term, because they will likely show the likely short-term direction of the market, and so we want to be able to use that to sort of trade with the trend. Okay, trade with the dominant trend. Okay, and we talked quite a lot about that last week. So this week, having looked at pin bars last week, this week I thought we would look at another very simple price action setup, okay, that we can start to add to our armory, so to speak, and it's called the engulfing candle. Some people might call it outside bars, okay, but as a general rule, we look at calling it as an engulfing candle, and you'll probably see me describe it as EC, okay, in my own particular way and vernacular. What is an engulfing candle? Well, quite simply, the high and the low of the bar engulf the range of the preceding bar. They're much less frequent than the pin bar, but they tend to be more powerful, especially when they happen at a particular time and place. Remember, we talked about that confluence of events, and because when it does, it signals a significant change in the trend or the sentiment. And, it really is a reversal pattern. And we can see here, what we're looking to see is that the high and the low of the candle. This is a bullish engulfing candle. It completely engulfs, okay, the range of the preceding bar. That's what we're particularly looking at, okay. Or on a bearish engulfing candle, okay, we have our high and our low there, and and it really engulfs, okay, it engulfs the range of the preceding bar. That's what we need to see, okay. And what it does is when this happens, okay, at certain times and places, it gives us just a really good indication of the complete change in the sort of in the trend and the sentiment, and we can use that information to help us take a new trade. So what we'll see is, it's a two candle setup. So, you've got what happens is the first candle closes in one direction, and then the second candle will reverse and goes in the opposite direction. Preferably to begin with, we prefer not to have large tails. Okay, as you grow in experience, okay, you might really look at that. But as a general rule, we prefer, to not have any large tails, because I want you to think of almost like the psychology of it, okay? The psychology of the market. What is it doing? And when you get a huge, sort of swing there in the sentiment, a huge change in that, well, then that's what we want to identify. Well, who is now in control of this market? That's it. Who is now in control of this market? And that's what we're interested in. So here's a few examples of bullish engulfing. Okay, now and here we go. You can hopefully probably see, how very, very clearly, this, they're engulfing the preceding bar. We have the first bar, okay, is a bearish bar, and the second one, is a bullish, and it completely engulfs. Okay, and it's the same we have on this one. But what we don't like about this, even though the range engulfs, okay, what I'm kind of a little bit hesitant about is, we've still closed down here in the in the sort of in the middle of the range of the bar. Okay, the preceding ones here, okay, these ones, they've closed on their highs. Okay, there's not really any wick there to the upside, and that's because it's a very strong close. And as I said, think about the psychology of the market. I want you to get an idea that in this case the bulls have stepped in. They have taken control of the market. That's what I want to know. Who is in control of the market? And that's what we're learning. That's what we're seeing, and that's what we're going to work with in our trading. For the bearish one, well, it's just pretty much the same, but in reverse. We can see that it really engulfs the range of the preceding bar. The preceding bar was bullish, went up, and then the next one just went all the way down. Okay, and you can see in the first two, it really closes on its lows. There's not really much of a wick there at all. Whereas this one here, okay, yes, there is a range, but actually we can see that it closed about halfway down the bar, so that there must have been some bullish pressure to basically push it up, and that's not what we want. We want complete overwhelm of that market. We want to basically understand and see, that as I said in this particular case, that the bears have stepped in and completely wrestled control of that market. So, what we're looking to do is that, as I say, engulfing candles, they happen rare. Okay, they happen much, they're much rarer than pin bars, but they tend to be a very strong signal. Okay, but what we do, or what to give us an edge, is that if you want to understand simply what you should be doing, is that you should be trading in the direction of the close of the engulfing bar. So for that, this in this particular case, let's get the old pen out again. Okay, we closed here. Okay, we've closed as a red bearish candle. Okay, we're going to be looking to trade in that direction because we're expecting the market to longer term to continue on in that particular direction, and that's what we're looking to work with. So today, what we're just going to talk about is the kind of basic entry criteria. I'm going to, in later sessions, I'll give you some more advanced insight into ways to trade it. But based on what we've just said there, okay, remember that we're going to trade in the direction of the close. All right. So this was a bearish candle, and what we'd be looking to do is to for the basic is to enter on a break of the low. So we'll be basically placing our order beneath the low of the candle. Okay, certainly for kind of for sort of kind of longer term trading time frame. So you're looking at 4 hour, daily, weekly, maybe even monthly. Okay, you're going to be looking to sort of have an order on the short side there between sort of 5 to 10 pips or ticks beneath the low, and so that when price breaks it, it will take it down and carry it through. Furthermore, our stop loss will be on the other side. Okay, the exact other side of it. Okay, and that basically that gives us a that gives us quite a significant trade risk. Okay, and as I said, I'm going to show you how that can be reduced going forward in one of the more advanced sessions. And when you're looking at engulfing candles can be quite big, so we just tend to say you're looking at for a 1-to-1 reward to risk ratio on the basic entry criteria. As I said, I'll in sessions to come I'll teach you a few more advanced sort of entry options, but to begin with today I just want you to be able to sort of take away a basic one and take away and look for it on your own charts from tomorrow. So yeah, this was an example from actually from gold on the weekly chart. Okay, we had price had been going up. Okay, and then effectively we had this big bearish engulfing candle. Okay, that just overwhelmed market, and then what we saw is that price actually just kept going all the way down, and that's what we want to be. We're trading in the direction of the close of the bar. That's what we're actually looking at, and that's what we're looking to. That's how we use it as our edge. Okay, we're looking. It's a reversal pattern, so we want something that there needs to be something there to reverse. Okay, so and I'll show you a couple of examples of that later on about having ideas where the actual we need to have a trend beforehand so it can actually act as a reversal pattern and reverse the trend, and that's what we're looking for. So here's a couple of examples. So that should be pound against US dollar. But this is the weekly chart here. Okay, so it doesn't happen as I said, doesn't happen as often as we would like. But when you're looking at lots of charts, okay, that will that changes very, very quickly. But what I've drawn in here is we can see actually at the start of it, price was going down, and then what we actually had here was a really rather big bullish engulfing candle. Okay, and we also had another one here. Okay, after price moved down, okay, we had another one here. Price completely engulfed the sort of the range of the bar before, and we can see that actually became the sort of the start of a good move up. That's what we saw. And if I just take off the erasal drawings, this one, this is one I sort of said that is not, I put that little cross by it. And why is it? Because remember, we were talking about this is a reversal pattern. Okay, so I like to see something to reverse, whereas actually here, yes, it did engulf the bar before it. Okay, but actually we had already sort of turned, and we were already in the uptrend, and whilst it did go on a little bit further. Okay, ultimately it wasn't really it didn't really work out in the way that you'd want to trade. So when you find an engulfing candle on the chart, just make sure that you can see that there was a trend beforehand for it to reverse. This one was the same here. Okay, price had moved up, price had already started to reverse, and then actually we can see, yes, this did engulf the preceding candle, but we had already sort of made the turn. We had already kind of were moving down, and actually in fact it was even if you had taken that trade, okay, there the order was would not have been triggered. Okay, and that's we can see the price actually just rose itself all the way up. But then what we did have is and this is we're talking about the confluence of events. Okay, is that price got back up to this that kind of 143 area. Okay, at the same time as as hitting the weekly 200 period moving average, hitting that kind of that previous highs. And then it put in, a really quite big, strong engulfing candle there. Okay, and we can see that that was just a really strong candle to let us know that overall uptrend is now over. And then what we've seen, and that's what we've seen this year, is that basically the price has fallen away quite significantly. So as I said, they don't happen very often, but when they do, they're definitely worth keeping an eye out for. This is just another example of it's kind of confluence of events here. Okay, this is and it's quite because it was a very good trade for myself, was that this was the euro dollar, okay, on the weekly chart, and actually price had been moving up. You might actually notice that we were in an uptrend, but when we pulled back, we had a little engulfing candle there. But this is about confluence of events, okay? So now I'm particularly looking at this candle here. What we had is euro dollar had been gaining in strength over the summer, and then what happened is we hit. Hopefully you can see here, we hit the sort of psychological level of 140, and this was about the same time as Mario Draghi, the head of the ECB, was coming out saying that he was going to be basically doing all he could to save the euro, and if that meant quantitative easing, that was what was going to happen. And so we saw that week it finished with that sort of big engulfing candle, okay, which had bounced, ended the uptrend, had bounced off the kind of the 140 level as well, and had been a really bearish close. And actually, what you can see is for the remainder of the year, that euro dollar just went in one direction, okay? And so that is about, and we'll build more on that, is about that confluence of events. That's about having 2, 3, 4 things come together at one kind of a point and area. And when you see that, okay, that's what we like. We can see we have the psychological number of 140, we have an engulfing candle after an uptrend, and we also had Mario Draghi, the sort of European central banker, making a speech about this. So as I said, you've got 3 or 4 things all coming together at one time, and that's what makes the big difference. So here's I thought this put up for a little bit of an interesting one, because for some of you, I appreciate some of you might not. You might wish to be an intraday trader, but you might not actually have the time because you've got a day job. You're trading around a day job, and this is actually the monthly chart of the dollar index here. Okay, and that in itself can be very interesting, very useful sort of indicator for us here. We can hopefully maybe you can see here. Okay, we for a few months we've been going down, and then boom, we get a really very big, strong engulfing candle on the monthly basis. And actually, go sideways for a little bit, and then we have an absolute push up here on the dollar index, and that dollar index that being pushed up on there, it is ended. Okay, it is ended by this big monthly engulfing candle. As I said, I will teach you later down the line more advanced examples of how to enter here to basically give you the opportunity to improve your reward to risk. But actually, that was January of 2017 that happened, and literally that set the tone for the dollar for the entire year. You can see that actually that's what actually happened there. That's we just saw that move. So as I said, it doesn't happen very often on a monthly chart, but when it does, then it's something to sort of take to definitely to sit up and take notice of. So, just remember, as a final point before we're going to have a little look on the charts, okay, engulfing candles, they happen rarely, but they do tend to have a very good high probability. They demonstrate total overwhelm. Okay, just think about that. It's just the participant have stepped in and they've wrestled control of the market. So we look to trade them at the end of trends because they're a reversal pattern. All right, you might show up here and there, but we want to see them at the end of a trend, giving us something to show us that trend is over and that a reversal has taken place. So, we look for a bullish engulfing candle at the end of a downtrend, and we look for a bearish engulfing candle at the end of an uptrend. And what we look to do is to trade in the direction of the close of the bar. That's what we're looking at. Trade in the direction of the close. That's it. So, there we go. We've just covered a bit on there on engulfing candles. Okay, we'll go and have a little look at the charts here for the last 5-10 minutes. What I talked about, okay, for the last few sessions is, as we go through our mastering 4 M's of trading, we'll build a sort of a profile around about some of the major instruments that the Admiral Markets MetaTrader 4 Supreme Edition provides and offers to you. So, we'll sort of look at building a profile there. We have the dollar index, okay, in FX pairs, you want to know what that is, and then I have sort of 28 major FX pairs, which is basically the cross pollination of the major pairs against the dollar. We will also have we'll also be looking at here we go. We'll be looking at the sort of the major indices. So we've got the major American indices there: S&P 500, Dow Jones, Nasdaq. Have a look at some of the major European ones like FTSE and DAX, and some of the major Asian ones. So we can have a look at the things like the Nikkei, and we'll also have a look at the China A50 as well. We'll also take looks at the commodities, primarily the hards, okay, the sort of oil, gold, and silver and copper, okay, because those are the things that are dug out of the ground. That's why they're called hards. And we may occasionally have a look at one or two of the soft commodities, okay. That's the ones that will grow, so wheat, sugar, soybeans, cotton, and cocoa. Yeah, we've already touched upon FANGs and some of the other interesting charts that we see out there, okay. So of course, we talked about Tesla being interesting, and also now Admiral Markets provide access to the cryptocurrencies. So we have the ability to look at things like Bitcoin, Ether, Litecoin, and Ripple, and we'll keep an eye on them as we go. So remember, ladies and gentlemen, just that, the good traders I have seen and worked with, they're always managing those 4 M's of trading: markets, method, money, and myself. And you have to ask yourself, are they all in alignment with yourself? Are you managing them well? If you're struggling in your trading, well, just take a bit of time to sort of do a little review and check how you're trading against those 4 M's. Constantly monitor them, okay? And it can be quite simple, just a little simple check-in with yourself, or maybe a daily on a weekly basis. And as always, if you've got questions about today's session or any of the others, or if you've got questions about the Admiral Markets proposition, well, then by all means, feel free to get in touch with your account representative. All right, you can call them on that London number 02077264003. You can email them at hello@admiralmarkets.com, or you can watch them on the YouTube channel or the Facebook page as well. So there you go, ladies and gentlemen. If you just bear with me a few minutes, I'll just sort of try and switch across to the Admiral Markets platform, and we'll have a little look at there for a few minutes, and that will take us through to sort of the end of today's session. So as I said, just bear with me, and we'll go and have a look at some charts. Super. So here we go. I'm hoping that you can all still. I'm hoping that you can still all see my charts there. Okay. So I'm just looking at this. Is the DAX chart. Okay. So we've got a 4 M's of trading profile. I was just quickly going through to see if we had any really interesting engulfing candles. Okay, so we had on the daily chart here, I'm just looking at this, it's I just remember I was saying that we want to see it at the end of a little trend. Okay, price falls down, there's one there, okay, and that sort of just sets it up to move onwards. If I like to look at the kind of the longer time frames, in particular, okay, we're just looking at this one here, just a case of we can see one here, okay. So it was we've been in a really very strong uptrend. You can see that, okay. So the weekly chart, the DAX, and then invariably we just reversed there, okay. And what happened is it came back to retest it before it fell away as part of the sort of damage done at the start of this year. So it becomes, as I said, it becomes important to sort of look at those markets, okay. Look at where the actual the actual price action candle shows up, because that can give us some fascinating clues as to what's actually been going on there, okay. And as I said, remember, we're looking for something that is going to sort of change the end of a trend, okay. So we want to see bearish engulfing candles at the end of an uptrend, okay. We want to see bullish engulfing candles at the end of a bear trend, because that's telling us that the other side have stepped in and absolutely wrestled control of what's going on, and that's one of the things we want to be aware of. We don't want to fight that. We want to work with that if possible. Okay, so we have a look here. Here's this is dollar Swiss franc. Okay, so I'm just going to look on the monthly chart. Just we can see that I'm just going to do as we've talked about here, and namely that's just a case of as soon as you're opening a chart, I'm just starting at my on the monthly chart, and just looking to sort of draw in significant levels of support and resistance that I can identify myself. Okay, for some reason I haven't done it already on this particular profiles dollar Swiss chart, but hopefully you can see there. We can just see we're just getting an idea of where some of those particular levels are of interest and relevance to the market itself. Just there we go. So there's just on the sort of the weekly chart. Sorry, that was the monthly chart. If I just have a quick look to see, was there any real interesting engulfing candles on a monthly basis? No, nothing. There's not as as I said, they don't happen very often, not as often as we would like to think so. I would be looking at this candle here. Okay. So price was in its downtrend. Now we completely engulfed, and we had quite a strong close on it as well before we actually sort of moved up from it. But there's actually interesting. There's not too many of those. Not too many of those, and those are golfing on the monthly chart. And then we can just go and have a look at the weekly chart. Okay, as I said, they don't happen very often, but on a weekly chart, okay, you might get a few a year. Okay, but if you're looking at, let's say, 40 different currencies and markets, well then if you're only going to get a couple a year, well then actually that provides plenty of opportunity when you're trading it all over those those many instruments and those many time frames, and that's something that you can utilize. You can take note of and work with going forward. But it's literally a case of as we've gone down to the weekly, start to just identify sort of newer, closer, tighter ranges, okay, to be able to sort of draw them onto the charts, so we can just constantly complete and build a picture about what's the what's the actual market doing. So we can see there on the dollar Swiss. Okay, we can see there for a good while that the dollar was very strong. Okay, the dollar was very strong indeed. It was really flying up there. Okay, and then what happened was that we've gone into a little bit of a consolidation range here. Okay, we've gone into a bit of a consolidation range, and actually now what's happened is we've broken south of that range. Okay, and decided to move down, and that's what we're looking at. That's how that's particularly happening. So we were just we were consolidating, and then invariably now we're in that sort of we're in that kind of trend there. Okay, and that's something for us to sort of keep a particular eye on. So, as I said, just quickly going through some of the charts. Well, just to finish up, just go through what we've kind of looked at and covered. Look at that. We can see that hopefully you can see that is just a very clear example of a trend. Okay, there's no. I would hope there's no fighting over about whether that's consolidating a trend. That's the S&P 500, and we can see that basically. We can see that after we had a bit of a sort of the crash there, okay, 2007, 2008. Then from March 2009, we've done nine and a half years of uptrend. Okay, it's just quite something to behold. We've not really seen huge amounts of engulfing candles on this, certainly on the higher time frames, and that's fine. It's a case of, if there's nothing to do, then you do nothing. Okay, remember what I said earlier on. It's about avoiding having to force a trade. Never look to try and force a trade, because that never works well. So there you go, ladies and gentlemen. Okay, that's our session for today. So I hope you found that useful. I hope you found that a little bit insightful. Okay, into engulfing candles and where and how they can start to fit into our bigger picture. It's hopefully you'll be able to join me next Monday for our session, and we'll be going on to another price action setup. Okay, and we'll be doing that for the next couple of weeks, and then that will give us a suite suite of basic trading ideas that we can take away and work with in our own trading as we start to improve and get better. So as always, I wish you the very best of success in your own trading, ladies and gentlemen, and I look forward to sort of seeing you next week. Some of you might join me for the Tuesday morning real-time daily trading ideas. That's 5 traders, 5 days. Okay, I do the Tuesday 10 o'clock London slot. You'd be very welcome. All of the sort of concepts I talk about here is what I sort of utilize in there. Okay, on a day-by-day basis. And if not, as I said, I'll look forward to sort of seeing you at our session next week. Thank you, and trade well, ladies and gentlemen.